About buying merchandise. Buying merchandise. Now, for starters, what is merchandise? It is goods that we buy to do what with? To resell. Not to use in our business, but to resell. When I buy something to resell, I have more inventory. I normally call it inventory. The official account title is merchandise inventory. You can abbreviate that MI even if you want to. But we have more inventory when I buy goods to resell. Inventory is an asset, and assets go with a debit, so I'm going to debit merchandise inventory. I would have either less cash or more accounts payable, depending upon whether or not I paid for it, and that will be my credit. So debit inventory to make the asset go up, credit cash or accounts payable to make either the cash go down or the accounts payable liability go up then. Now notice what I don't do. I don't charge this merchandise to an expense account when I buy it. It's really a lot like the supplies. Remember when we talked about supplies and we said when we buy the supplies, they are what to us? An asset. They're an asset when we buy it. When do they become an expense to us? When we use them up. Similarly, inventory when I buy it is an asset to me. It will become an expense to me only when I sell it. Why is that? Because when I sell it is when it generates revenue. And remember the matching principle says we want to match the expenses with the revenues they help generate. If I sell an item, that means it generates revenue for me this period. I want to take its cost and record it as an expense also this period in the same period as the sales in. So not an expense when I buy it. It will become an expense called cost of goods sold, but only when I sell it then. All right, we buy 8 droids to resell from C3PO for $1,000 each. Okay? So we're buying items to resell for $1,000 each. 8 times 1,000, would we agree that that's 8,000? Let's make a journal entry. First off, assuming that we made the purchase on account, we promise to pay for it later on. What do I have more of? What's one thing? I have more inventory. Inventory is what type of an account? It's an asset, more of an asset. It's going up. How do we make an asset go up? With a debit. So I'm going to debit merchandise inventory to make the asset go up. What else do I have more of? In this case, I owe more money. I have more accounts payable. What type of an account is accounts payable? It's a liability. It's going up. We make a liability go up with a credit. So I would debit merchandise inventory to make that asset go up. I would credit accounts payable to make the liability go up. Again, more inventory and asset goes up with a debit. More accounts payable, a liability goes up with a credit. What if instead we had paid cash for the merchandise? Bought the merchandise and paid cash for it. What do I have more of? More inventory. Inventory is an asset and assets go up with a debit. What do I have less of? Less cash. Cash is an asset and it goes down then with a credit. So notice the only difference between those two entries is the credit. If I pay for it now, I credit cash. If I promise to pay later on, I'm going to credit accounts payable. In both cases, I debit merchandise inventory because I have more inventory. That's an asset and it goes up with a debit. Purchase discounts. Sometimes when we buy merchandise, merchandise being what? Goods that we buy to resell. The vendor that we buy it from may offer us a discount as an incentive to pay them early. They offer me a discount as an incentive for me to pay them early. Why would they do that? Why would they give me a discount for paying them early? They need their money. They need their money so they can pay their rent, pay their employees, buy more merchandise. Often companies need their money now, so they might choose to offer us a discount for paying them earlier. That's stated via something we call our sales terms. Sales terms. Now here's an example of some terms. Do you see 2/10, comma, N/30? The way we say that is 210 net 30. 210 net 30. That means I may take a 2% discount if I pay by day 10. Otherwise, if I don't pay by day 10, I've got to pay the full amount by day 30. 210 net 30. A 2% discount if I pay by day 10. Otherwise, the total comes due on day 30. Now, there's some part of that I really don't like the terminology, and that is the word net. When it comes to amounts, or net is one amount, it's kind of a reduced amount. What's the opposite of net? Gross. You got gross and you got net. Which one's bigger? The gross is bigger. The net is after something has been deducted. So really, I think the best way to say this would be 210 gross 30, because if you don't pay by day 10, do you pay the reduced amount on day 30? No, you have to pay the entire total amount on day 30. Another example, 1/EOM says I can take a 1% discount if I pay by the end of the month. Otherwise, in this case, the total would come due in day 60. So those are just examples of terms. Each company comes up with their own, the most common being 210 net 30. Sometimes also you just see the terms net 30, which means you must pay in 30 days and there's no discount offered then. If terms are given in a transaction, it is always a credit transaction. Even if they don't say we bought something on account, if it says we bought something 210 net 30, it's a credit transaction. So even if those words do not appear on account, you know it's a credit transaction. How do we record a purchase discount? We're going to make an assumption, and that is that we will always, 100% of the time, take the discount if it is offered. So when we record the initial purchase, we are going to record it at the reduced amount that we would pay if we are going to take the discount. So we will assume we will always take the discount. What does that mean? Let's assume we make a $100 purchase, terms 210 net 30. If I were to take the discount, I could save 2%. 2% times 100 says I would save $2. 100 minus 2 says I'm going to record that purchase then at $98. It is a $98 transaction from here on out. So when I make the purchase, I'm going to debit merchandise inventory to make the asset go up. I'm going to credit accounts payable to make the liability go up, but the amount now is going to be $98. Let's do an example. When we bought the droids, 8 of them, $1,000 each, but it was an $8,000 purchase to begin with. But this time we're going to assume the terms are 210 net 30. 210 net 30. What does that mean? If I were to pay by day 10, I could take what percent discount? 2. So how much of a discount can we take if we pay within 10 days? Well, 8,000 times 2% says I can save how much? 160. 8,000 times 2% says I'm going to save $160 in total. So how much are we going to pay if we pay within 10 days? $7,840. We owe 8,000. We're going to save 160. It says we're going to pay $7,840. When we record this purchase now, we're not going to record it for $8,000. We're going to record it for $7,840, assuming we will always take the discount. So let's make the journal entry to record making the purchase. Again, what do I have more of? Merchandise inventory, that's an asset that goes up with the debit. The amount of the entry now is going to be $7,840. The amount we would pay if we take the discount. What else do I have more of? Accounts payable. Accounts payable is a liability and it goes up with a credit. So just like before we debit merchandise and merchandise inventory and credit accounts payable, this time though, the amount we recorded at is what we would pay if we were to take the discount. All right, well how about later on day 10, we make the payment. What do I have less of? What's one thing? I have less cash, which is an asset and it goes down with a credit. What else do I have less of? Less accounts payable. My debt has gone down and liabilities go down with a debit. So we will debit accounts payable to make the liability go down. We will credit cash to make the asset go down. What if I pay on day 30, not day 10? We're not going to worry about that. We're not responsible for that. So we're going to always assume that we pay in time to take the discount. So what was different about this in the original time we recorded these? Because the discount was offered, we're going to record the original purchase at the amount we would pay, assuming we take the discount. Then we pay that exact amount when it comes due. My payable goes down, and so does my cash. Let's next talk about purchase returns and allowances. A purchase return is when I have bought merchandise and I return it. What is merchandise? Stuff that we bought to do what with? Resell. So we buy something to sell, we don't like it, we take it back. You've returned stuff to the store before, right? It's the same concept. We bought something, we didn't like it, we take it back to the store. A purchase allowance is similar. We bought something, we didn't like it, but this time instead of physically returning it to the store, we keep it as long as they reduce the price that we owe them. So we don't physically return the goods, they just reduce the amount that we owe them. We're going to account for these the same as a return versus an allowance, so I'll just talk about returns, but they both work the same way. Again, it's got to be merchandise, items that we bought to resell. If we've already paid for the merchandise, they've got to give me my money back. If we have not already paid for my merchandise, they're simply going to reduce the amount that I owe them right now. So if we haven't paid for the goods yet, let's think about it. I return merchandise, I haven't paid for it yet, I still owe it. What do I have less of now? We have less merchandise, my inventory goes down, that's an asset, and it goes down with a credit. Good. What else do I have less of? I have less accounts payable. My debt has gone down because if I owed $1,000 and I sent back $200, I no longer owe $1,000, do I? Okay, so my debt, my liability has gone down. So when I return the merchandise, I'm going to debit accounts payable to make my liability go down. I'm going to credit merchandise inventory to make the asset go down. What if I have paid for the items already? Will they give me my money back? Yes. So now I have more cash. An asset goes up with the debit. And again, I still have less inventory. An asset goes down with a credit. So the only difference between the two is the debit, accounts payable versus cash. How does that impact merchandise inventory? Well, crediting inventory makes it go down. Why is that? We return the stuff. We send it back. We do not have as much inventory anymore. Let's do an example. We returned 2 of the droids. Remember we bought 8 of them? We didn't like them. We sent back 2 of them. $1,000 each is what we paid for them. Okay. So what amount are we looking at for the return right here? $2,000. Now we're going to assume first that there was no discount offered. Let's record returning the items, assuming we haven't paid for them yet. Will they give me money back? No. They're just going to reduce the amount that I owe them. What do I have less of? What's one thing? I have less accounts payable. That's a liability, and it's going down then with a debit. So we'll debit accounts payable. And what else do I have less of? Less inventory. I send it back. Inventory is an asset, and it goes down then with a credit. So let's debit accounts payable to make the liability go down, credit merchandise inventory to make the asset go down. How about if I had already paid for that merchandise? I've already paid for it, and now I return it. Will they give me my money back? Well, yes, they will. Yes, they will. What do I have more of? More cash. That's an asset, and it goes up with the debit. What do I have less of? Merchandise inventory. An asset goes down with a credit. So if I've already paid for the inventory, they give me cash back. If I haven't, they're going to reduce my debt, the amount that I owe them. In both cases, I credit merchandise inventory to make the asset go down. Part of it's gone. I send it back. What would be different about that entry if, when I originally bought the merchandise, I was offered a discount? That discount we're talking about is called a sales discount. The seller calls it a sales discount. Okay? So what if I had been offered a sales discount when I originally bought it? Well, let's see. Remember when we record the purchase? We record the purchase at the reduced amount, assuming we will take the discount. So if we then return part of that purchase, we've also got to record it at the reduced amount we would have paid if we were to take the discount. Because the items went into inventory at that reduced amount, if we return them, they've got to come out of inventory at that reduced amount also. Princess Leia returns 2 of the droids, $1,000 each, $210 net 30. The amount of the return still was going to start off with $2,000, but now there was a discount offer, $210 net 30. What is the amount of discount related to this return? $2,000 times what percent? 2. Says that would be a discount of how much? $40. All right, how much then will the return be recorded for? If it was $2,000, but we've got to take off this discount, instead it's now going to be recorded for how much? $1,960. So it's not a $2,000 return. It now is a return of only $1,960. Why is that? Because the items went into merchandise inventory at the reduced amount. So now when we send them back, they've got to come out at that same reduced amount. Well, let's record returning the item. First off, assuming she has not yet paid for the item. She hasn't paid for it yet. Will they give me my money back? No, haven't paid for it yet. What do I have less off? What's one thing? Accounts payable. My debt has gone down. My debt has gone down by $1,960 because that's what I put it into accounts payable. Remember, was at the reduced amount. So now when I take it out of accounts payable, it's also got to be at the reduced amount. So debit accounts payable for the $1,960. What else do I have less off? I have less inventory. Inventory is an asset and it goes down with a credit. So I have less inventory. Less accounts payable, make the liability go down with the debit. Less merchandise inventory, make the asset go down with a credit. But notice the amount, that's the key difference. No longer do we record it for $2,000. We now record it for $2,000 less that 2% discount. What if we had already paid for this merchandise? Would they give me my money back? Yes. So let's assume we return the merchandise. A discount was offered at the time of purchase. What do I have more of now? Cash. How much cash are they going to give me? Well, just the $1,960. Just the $1,960. A discount was offered. I took the discount. I didn't actually pay $2,000 for 2 droids. I would have only paid $1,960. Debit cash to make the asset go up. And what do I have less of? Less inventory. That's an asset and it goes down with a credit. So notice the only difference between these two sets of entries and the ones we did a minute ago is that this is recorded at $1,960, the reduced amount. Previously they were recorded at the full amount.